At this very moment, the IRS is holding $4,873 that rightfully belongs to you. And if you fail to submit one particular form before the cutoff date, that money vanishes forever. No extension is available, no appeal process exists, no way to recover it, it is simply gone. This video exists to make certain that outcome never happens to you. Here is what the majority of seniors have never been told. The IRS will not send you a check on its own. The IRS will not pick up the phone and call you. The IRS will not send your tax professional any kind of reminder on your behalf. There is currently more than $1 billion in unclaimed refund money sitting idle inside federal accounts at this very moment. Every single dollar of it belongs to real individuals who were fully eligible, who genuinely earned it, and who simply never submitted the form that initiates the payment. The system functions on a completely reactive basis. You make the request, and then you receive the funds. You never make the request, and the money transfers permanently into the U.S. Treasury with zero legal recourse available to you once that window shuts. And the tax preparation industry, a $14 billion annual enterprise, has absolutely no financial motivation to make any of this easier to understand. The more confusing and intimidating the process appears, the more seniors hand over money for assistance they may not actually require. My name is Lana Maines. I represent taxpayers in direct proceedings before the Internal Revenue Service. I sit on the opposing side of the table from the IRS on behalf of everyday people. And the single most heartbreaking pattern I encounter is not tax fraud. It is not financial recklessness. It is honest, diligent women in their 60s and 70s who qualified for a fully legitimate IRS credit, whose money was sitting there in a federal account ready to be claimed, and who never once filed the triggering form because nobody ever informed them it was an option. That is the most costly variety of mistake that exists. It operates invisibly. There is no penalty letter arriving in your mailbox. There is no notification of any kind. There is simply money sitting quietly inside a government account that never found its way back to the person it genuinely belonged to. The IRS will never notify you that you missed this opportunity. You will never receive an explanation for why most tax preparers never brought this up. The Earned Income Tax Credit has existed within the tax code for several decades, but the qualifying rules for seniors underwent significant changes. Recent IRS provision updates established a specific eligibility pathway for individuals aged 60 and older. And the training provided at large commercial tax preparation chains has simply not kept up with those updates. This is not a legal gray area or a workaround. It is a formally documented IRS credit mechanism that exists under the Internal Revenue Code. The gap between what is actually accessible and what gets successfully claimed is not an eligibility problem. It is a knowledge problem. And that gap is draining real dollars from seniors during every single filing season. That brings us directly to the two categories of people who leave this money uncollected year after year because each group has already constructed a personal reason for why filing does not apply to them. The first group is the existing filer. She submits her taxes every single year. She works with either a CPA or a national tax preparation chain. She operates under the assumption that if any benefit were available to her, her tax preparer would have flagged it automatically. That assumption is actively costing her money she deserves. The Earned Income Tax Credit is not applied to a return automatically. It must be deliberately triggered as part of the filing process. Numerous preparers complete every other section of the return with complete accuracy and simply never run the EIC eligibility evaluation for a senior filer. The preparer committed no technical error on what they submitted. They simply never checked a box that was never placed directly in front of them. The second group is the non-filer. Her income sits low enough that she falls beneath the federal filing threshold. She has not submitted a tax return in multiple years because she is not legally obligated to do so, and she operates under the belief that if she owes no tax, there is no purpose in filing anything. That belief is equally incorrect. Low income is not a disqualifying condition for this credit. In a significant number of circumstances, low income is precisely the qualifying condition. Submitting a return, even in a year when you owe absolutely nothing, is the specific mechanism that unlocks the refund payment. Nobody who finishes watching this video should leave believing this situation does not apply to their circumstances. Both groups arrive at the same incorrect conclusion through entirely different reasoning paths, and both conclusions lead to the same financial loss. That brings us directly to the exact figures, because the numbers themselves are the most efficient way to demonstrate the point clearly. Here is what each group stands to gain. The IRS establishes maximum credit amounts organized by filing category. For a single filer with no qualifying children, the maximum credit amount in the current tax year is $632. For a filer with one qualifying child, the maximum reaches $4,213. For a filer with 3 or more qualifying children, the figure climbs to $6,960. The income thresholds required for qualification cite under $18,591 for a single filer, and under $49,084 for married filing jointly. There is also an investment income cap that applies. If your total investment income exceeds $11,600 within the tax year, you do not qualify regardless of how much earned income you have generated. That figure is specific and precise. Verify it against your actual account statements, not a rough estimate you carry in your head. One detail that seniors overlook on a consistent basis. Social Security income alone does not qualify as earned income for the purposes of this credit, but receiving it does not eliminate your eligibility either. If you have any earned income layered on top of your Social Security benefits, even income from part-time employment, compensation for watching grandchildren, occasional repair or handyman work, or revenue from selling goods online, you may qualify, and the full calculation must be properly completed. Even modest amounts of self-employment earnings can open the eligibility door. If you are a lower-income senior, the $632 floor applicable to filers with no qualifying children represents the minimum possible outcome, not the ceiling for your particular situation. Your specific credit amount depends on your individual earned income calculation, and for many seniors positioned within the lower income range, the final number lands considerably above $632. If you are a more financially comfortable retiree, the $49,084 married filing threshold makes clear that this program is not designed exclusively for seniors experiencing financial hardship. A retired couple drawing pension distributions, modest Social Security income, and some interest earnings may still fall comfortably within the qualifying income range. Run the actual numbers against your real documentation before you remove yourself from consideration. Right now, pause this video and pull up your most recent tax return or your latest Social Security statement, not a rough mental estimate of your income, the precise figure printed on the actual document. Locate the adjusted gross income line on that document, because everything that follows depends entirely on where that number stands in relation to $18,591 or $49,084. The first form you need is Schedule EIC, and it is attached directly to your standard federal return on Form 1040. Schedule EIC is not submitted as a freestanding document on its own. It attaches to the 1040 and activates the IRS eligibility calculation process. Both forms are available at absolutely no cost through irs.gov. You do not require a third-party service provider. You do not need to pay any filing fee whatsoever to access these documents. The second form that most seniors never encounter is Schedule R, the credit for the elderly or disabled. This particular credit has been part of the tax code since 1976, and it was designed with the specific intention of serving seniors living on fixed incomes. It stands as one of the least frequently claimed credits in the entire federal tax code. Not because only a small number of seniors are eligible, but because the majority of tax preparers never navigate toward it during the preparation of a standard return. If you are 65 years of age or older, Schedule R should appear on your return. If it is absent, you should ask your preparer for a direct explanation. The 2025 tax year incorporates a new senior bonus deduction that functions to reduce your adjusted gross income. That reduction has the practical effect of pushing seniors who previously calculated themselves outside the Schedule R credit back into qualifying territory, particularly for individuals earning between $20,000 and $35,000 annually. If your tax preparer has not raised this topic with you, ask them point blank. Ask them whether they ran Schedule R with the revised adjusted gross income after applying the senior bonus deduction. A preparer who is genuinely current on 2025 tax law will answer that question without hesitation. A preparer who is not current will respond with vague language or a visibly confused expression. That response alone tells you precisely what you need to know about how thoroughly your return was reviewed. There are 3 sections on Schedule EIC where senior filers most consistently make critical errors. The first involves the earned income calculation itself. Earned income for the purposes of this credit includes wages, self-employment revenue, and certain qualified disability payments. Social Security benefits by themselves do not count as earned income for EIC eligibility purposes. If your sole source of income is Social Security, you do not meet the qualifying criteria. If you carry any earned income alongside your Social Security, even a modest amount from occasional part-time work or minor self-employment activity, you may qualify and the calculation must be executed with precision. The second error that appears frequently involves leaving the investment income line completely blank or reporting a figure that is lower than the actual amount. If your investment income exceeds the applicable cap, the credit is eliminated entirely and reduced to 0. That number must be reported with complete accuracy. The third error involves filing status discrepancies. The filing status you indicate on the 1040 must correspond exactly with the status you indicate on Schedule EIC. Any mismatch between those 2 forms triggers processing delays and in certain cases results in automatic disqualification that then requires the filing of an amended return to resolve. If you need assistance with filing, 2 no-cost programs exist specifically for senior taxpayers: VITA, which stands for the Volunteer Income Tax Assistance Program, and TCE, which stands for Tax Counseling for the Elderly. Both carry official IRS certification and are available completely free of charge. TCE, operated through AAR P-Tax Aid, focuses specifically on retirement-related tax matters, including pension income, Social Security taxation, Schedule R filings, and EITC eligibility for seniors. Participation does not require an AARP membership of any kind. Visit irs.gov to search for VITA locations in your area or dial 800-9069887 to identify the nearest TCE site available to you. That covers the forms. Now here is the deadline information. And this is the point where people who believed they were safely within the time frame discovered they are not. The IRS enforces a firm 3-year look-back window that applies to all unclaimed refunds. Once that window closes on any specific tax year, the refund is permanently forfeited without exception. It is transferred directly into the U.S. Treasury. No appeals process is available. No exception applies for senior taxpayers. No hardship-based waiver can be requested. The window closes and that money is gone without any possibility of recovery. The deadline associated with the 2021 tax year falls in April of 2025. If you did not claim the Earned Income Tax Credit or the Schedule R credit on your 2021 return and you were eligible to do so, that closing window is not approaching at some comfortable future point. It is closing right now, this season. The $4,873 figure, referenced from IRS data, represents the average unclaimed amount successfully recovered by seniors operating within this exact filing window when they submitted their forms before the deadline expired. If you engaged a paid preparer for your 2021 return, and those credits were not claimed on that return, you are legally entitled to submit an amended return using Form 1040-X. Here is the specific complication that consistently costs people the outcome they deserve. Most seniors interpret their preparer's silence on the matter as confirmation that they simply did not qualify. That is not the accurate interpretation of that silence, Numerous preparers will file an amended return without charging any additional fee if the original oversight originated on their end. Ask them this question directly. If they decline to do so, the amended return can be filed independently through irs.gov without requiring any outside assistance. You can also use the IRS Interactive Tax Assistant tool available at no cost through irs.gov to verify your eligibility for any prior tax year in less than 5 minutes using your actual documented income figures. If the tool indicates you qualified for a credit that does not appear anywhere on your existing return, you have confirmed a missed credit and a clear and legitimate basis for submitting the 1040-X. The IRS will never alert you that your window is in the process of closing. Here is the precise sequence of steps to complete before the deadline arrives. Step 1. Verify your filing status for tax years 2021, 2022, and 2023. Retrieve your returns or confirm your non-filer status for each individual year. If you did file, examine whether Schedule EIC and Schedule R were included as attachments. If either form is absent from the return, an amended filing is an available option for you. Step 2. Use the IRS-EITC Assistant tool. Navigate to irs.gov and search for the EITC Assistant. Enter your specific information for each tax year under review, and the tool delivers a clear and definitive eligibility determination in under 5 minutes. Enter the actual numbers pulled directly from your return rather than estimates. Step 3. Gather 3 specific documents before you open any form. You will need proof of earned income for the applicable tax year, your Social Security statement, and your prior year return if you are in the process of submitting an amended filing. Step 4. For the 2021 tax year specifically, verify the precise deadline that applies to your individual situation by visiting irs.gov and navigating to the unclaimed refund section. The standard closing window falls in April of 2025. Do not operate under the assumption that additional time remains beyond what the official documentation states. Step 5. Submit your completed 1040-X or original return directly through irs.gov, or deliver it via mail to the IRS address designated for your state on the form instructions. Retain a copy of every document you submit and make a written record of the submission date. The IRS currently holds your money. The forms you need are fully accessible. The deadline is absolutely real. The only factor remaining is whether you file your documentation before the closing window expires. Now you have that information. If there is someone in your life who is over 60 years old and has not yet heard about any of this, send this video to them today. It may be the one action that gets their money returned to them before the deadline permanently removes that possibility.